Welcome back to Smart Stock Sam. Today we are going deep on NIO. You already know the headline, Record Deliveries, a flagship SUV launch on the horizon, and an earnings report that could be the moment this stock finally wakes up. What we're going to do right now is go layer by layer through the investment thesis and ask the question every smart investor is asking, is this the last dip before a full-on breakout? Here is the 30-second version before we go deep. NIO just crossed 1 million cumulative deliveries. Their year-to-date growth is running at 77.3% versus last year. Institutions have poured nearly $1 billion into this stock in the last 12 months. Analysts have a consensus price target of $6.95, representing a 43.6% upside from current levels. The March 10th earnings call is less than 2 weeks away, and the ES9 flagship SUV officially launches in April. Every single one of those things is a catalyst. The question isn't whether NIO has momentum. The question is whether you're positioned before the market catches on. Let's find out. Let's start with the clock that is ticking on this setup right now. We are sitting in a window that does not stay open for long. Early March already delivered a signal. Weekly order backlogs hit 2026 highs. That is not noise. That is demand data telling you something. But the real line in the sand is March 10th, 2026. That is the earnings call. And current analyst estimates are projecting a loss of just 7 cents per share, a figure that would represent a historic narrowing of losses for this company. If they meet or beat that number, what happens to a stock that is already sitting below its fair value? And then look at April 9th. The ES9 SUV officially launches. Deliveries begin June 1st. If you are waiting for the news to break before you act, ask yourself, do you think the price will be lower after the launch than it is right now? Now let's talk about scale, because this is where the NIO story fundamentally changes. The biggest knock on any EV startup has always been the same question. Can they actually build the cars, not render them, not promise them, build them, deliver them, and keep doing it at volume? NIO just answered that question. They crossed 1 million cumulative deliveries. That number is not a marketing milestone. It is proof that the manufacturing operation works, the supply chain works, and most critically, that consumers keep coming back. When a company crosses that threshold, the risk profile changes entirely. The startup discount that has been dragging on this valuation, it starts to disappear. And if you think 1 million units was where the momentum peaked, the year-to-date data will change your mind immediately. In February 2026 alone, NIO delivered 20,797 vehicles, a 57.6% increase year over year in a month. And for the full first 2 months of 2026, NIO is up 77.3% compared to the same period last year. This is not a company slowing down. This is a company accelerating at a time when the broader market keeps telling us EV demand is softening. What does it mean when one player grows 77% in a market that's supposedly cooling? It means they are taking share from someone else, and that someone else should be worried. Here is something the bears consistently overlook. NIO is not a single brand anymore. This is a deliberate multi-tier strategy built to capture every meaningful segment of the EV market without cannibalizing itself. The core NIO brand holds the premium tier, clearing over 15,000 units and establishing the prestige ceiling. Then you have ONVO, positioned specifically for family-oriented buyers, the practical, high-volume market that funds everything else. And then there is Firefly, aimed squarely at the high-end compact segment. 3 brands, 3 price points, 3 distinct audiences. Could a company with weak fundamentals execute this kind of horizontal scaling simultaneously? Think about that. Now, those delivery numbers do not happen without a demand engine behind them. NIO has been extremely deliberate about generating order velocity right now. 7-year low-interest loan programs, purchase tax subsidies. The combination drove weekly new orders to a peak of 3,500 units in early March. This is not a company hoping the market comes to them. This is a company that understands how to manufacture demand as aggressively as it manufactures cars. But here is where NEO's story becomes something other companies simply cannot replicate: the battery swap network. On February 6th, NEO crossed 100 million cumulative battery swaps. Let that land for a second: 100 million. During the Lunar New Year period, daily swap volumes hit record highs for 5 consecutive days. This infrastructure is NEO's true moat. Tesla cannot offer it. Li Auto cannot offer it. It solves range anxiety at the infrastructure level, not just at the battery level, and it locks customers into an ecosystem that has taken years and billions of dollars to build. What would it actually take for a competitor to match that network from scratch? And would they even survive long enough to try? Now let's talk about the hardware that is about to put NEO's technology story on full display. The ES9 is not just a new model, it is a statement. It features the Skyride chassis system and, critically, the dual in-house Shenji NX 9031 chips. This is NEO's next-generation autonomous driving hardware developed internally. This is the Apple playbook applied to automotive. When you own the chip, you own the integration, you own the user experience, and you make it impossible for anyone running third-party hardware to compete on the same level. The ES9 is the product that proves NEO has crossed from assembler to technology architect. And here is the financial layer that most retail investors are completely missing when they look at those chips. NEO recently closed a $330.8 million investment round for its Shenji chip subsidiary from third-party investors. That values the Shenji unit alone at $1.5 billion. $1.5 billion. That valuation is sitting inside a stock that the market is currently pricing as if NEO is still a struggling startup. The chip subsidiary is being funded externally, meaning NEO gets the technology development without shouldering the full R&D cost. Hidden value, externally validated. When does the market start pricing that in? The answer might come sooner than you think, because the institutional money is already moving. Over the last 12 months, institutional investors have funneled over $963 million into NEO. Not retail speculation. Institutional conviction. D.E. Shaw and Company increased their position by 248% in Q4 2025, adding over 34 million shares. DNB Asset Management boosted their holdings by 141%. These are not momentum traders chasing a headline. These are firms that run rigorous fundamental models, and their models are telling them to buy more NEO at these prices. When the largest and most sophisticated allocators on the planet are accumulating, you have to ask, what do they know that the current price does not reflect? Here is what they see. Revenue expanding 70.9% year over year, with current quarter expectations at $4.61 billion, an 85.1% improvement in margin profile, and an EPS estimate for March 10th at a loss of just 7 cents per share. NEO is not profitable yet, but the trajectory toward profitability is no longer theoretical. It is measurable, quarter by quarter. And historically, the biggest price moves happen not when a company becomes profitable, but in the quarters just before it does, when the market finally accepts that profitability is real and imminent. Which brings us to the valuation. The consensus analyst price target right now is $6.95. That is a 43.6% upside from current levels. The most bullish analysts have targets reaching $9.37. And even the conservative, cautious names, JP Morgan, Morgan Stanley, are maintaining buy ratings with targets around $7. When the bulls and the so-called cautious analysts agree on the same directional call, what does that tell you about the current price? Before we get to the final verdict, an important reminder, like always. Everything discussed on Smart Stock Sam is for educational and informational purposes only. Nothing here is financial advice, and nothing here should be taken as a recommendation to buy or sell any security. I am not a licensed financial advisor. All investing involves risk, including the potential loss of principal. NEO is a volatile stock with real execution risk. The catalysts we discussed could underwhelm, delays could happen, and macro conditions can shift fast. Always do your own due diligence and consult a qualified financial professional before making any investment decision. Your money, your responsibility. Here is the bottom line on NIO. 1 million deliveries prove the manufacturing machine works. Year-to-date growth of 77.3% proves the demand engine works. 100 million battery swaps prove the moat is real and widening. The Shenji subsidiary proves the technology ambition is being externally validated. And $963 million in institutional inflows proves the smart money is not waiting for permission to get in. We have a premium technology company, not a startup anymore, trading at a valuation that still has startup discount math baked into it. The March 10th earnings call is the next pressure point. The ES9 launch is the next product catalyst, and the gap between what this company is worth and what the market is currently paying is as wide as it has been in years. That, to me, is a strong buy. If this breakdown gave you an edge today, smash that like button, subscribe, and drop your thoughts in the comments. I read every single one. See you in the next one.